The 6 teams competing today have already achieved significant success, winning their local competition, competing against all their neighbouring universities. They then went on to succeed in the second round of the competition based on the presentation of their excellent research analysis reports. Then earlier this week, they triumphed once again in the live regional semi-finals, offering superb presentations and surviving a lengthy question and answer session with panels of expert judges. We really are seeing the brightest and the best of finance students from right across Europe, Middle East and Africa. Congratulations to you all. The hard work you've put in is directly relevant to the content of the CFA programme, of course, and I hope you will all consider deepening and widening your knowledge by taking the next logical step, the CFA programme and the CFA Charter, joining 200,000 other successful CFA Institute members, leading the investment profession in markets all around the world. You are all winners by getting this far in the competition, and we would like to recognise this by offering every participant today in the EMEA regional final a CFA programme scholarship discount. We will share more details about this in May. That's every one of you here. I'd like to thank our volunteer panels of expert judges who have given their time and considerable commitment to support the development of all these future investment professionals from right across the region. Our judges are firm, focused, but fair, and we're very grateful to them all. Now to the details. Everyone is currently in the main session room. Throughout the event, we will move participants as appropriate to virtual breakout rooms where the presentations and question and answer periods for each team will take place. All teams, beside the first presenting teams, will be moved to their own individual rooms when the presentations start. Teams should remain connected and present in these rooms until they're moved to the presentation room. After a team has presented, you may disconnect and rejoin for the advancement announcement. Only timekeeper, teams and judges should have sound and video enabled at any time. All other attendees should remain muted and with your video off. A 1-minute warning will be provided for the presentations, but not for the Q&A period. As a reminder, the Q&A period for the regional final round will be up to 15 minutes. For the best viewing experience, we suggest hiding non-video feeds. There are many viewing options, so we suggest taking some time to find a view that looks best for you. Now, the teams competing today are the American University in Cairo, representing CFA Society Egypt, BI Norwegian Business School, representing CFA Society Norway and CFA Society Denmark. International University of Monaco, representing CFA Society France. Kozminski University, representing CFA Society Poland. University of Belgrade, representing CFA Society Serbia. And University of Neuchatel, representing CFA Society Switzerland. The judges today will be Matteo Lombardo, CFA, Asad Khan, CFA, Serkan Uzun, CFA, and Lorenzo Ferrara, CFA. Adrienne will be our timekeeper. At this time, we will start moving judges, guests, and then the first team into the presentation room. This may take a few minutes. We wish you all the very best of luck.
Okay, we can go ahead and get started. So welcome, American University in Cairo. At this time, please launch your presentation and make sure everything is working properly.
Ladies and gentlemen, amidst the rising risk of a global recession, investors flock to safe havens. Cleopatra Hospitals Group, Egypt's leading healthcare provider, stands tall. It is approaching a critical inflection point, capitalizing on accretive growth avenues, which enhances shareholder returns. Therefore, we, the American University in Cairo, initiate coverage on Cleopatra by issuing a buy recommendation based on our 11.73 fair value, implying a 44% upside from its 1-month VWAP. The healthcare sector in Egypt benefits from a population growing faster than peer countries. This population also faces one of the highest levels of diabetes, hypertension, and obesity, increasing the demand for specialized healthcare services, with Egypt having the highest private to total healthcare spending ratio in the MENA region. Egypt's private insurance market has also seen substantial growth, driving the demand for private healthcare, with 70% of Cleopatra's patient base being insured. Cairo, where Cleopatra is based, houses the highest level of private healthcare's target demographic. This growing demand, however, isn't met by sufficient supply in terms of bed and human capital, since Egypt requires roughly 38,000 beds to fill its market gap, with only 28% of total hospitals in Egypt being private, requiring an estimated $8 to $13 billion to finance the market gap, showcasing the substantial growth opportunity with a high barrier to entry, providing a strong advantage for incumbents like Cleopatra.
Cleopatra is the market leader in Egypt, operating a portfolio of 10 facilities. It strategically drives revenue through a multi-tiered model where outpatient services and emergency room cases form Cleopatra's initial patient touchpoints. These segments channel volume to more substantial service areas where roughly 5% of outpatient and ER cases converting to inpatient volumes. With a fully integrated medical value chain, coupled with expansion into suburban Cairo using semi-asset-light models, Cleopatra is uniquely positioned to drive returns. Healthcare players in Egypt generally operate business models that are exposed to pricing restrictions, foreign exchange, and geopolitical risks. However, we argue that Cleopatra is a structurally better business, backed by strong brand equity and management, and the only Egyptian-listed healthcare player with integrated healthcare facilities. And while it trades at a premium to local peers, we believe that this premium is not only justified, but does not fully reflect Cleopatra's value potential, predicated on our three main investment pillars. 1. Cleopatra is well positioned to capitalize on demand growth. 2. Strong management paving way for value accretion. And 3. Structural strength against recession concerns and solid M&A outflow.
Cleopatra is uniquely positioned to capture significant demand growth in the Egyptian healthcare market. We used a proprietary survey on 350 respondents of Cleopatra's targeted customer segments to evaluate brand equity for Cleopatra's expansion. We examined essential healthcare metrics such as cleanliness and medical quality, where we identified Cleopatra as the leading healthcare provider, with inline positioning compared to its niche market peers. Cleopatra also houses the highest number of beds and the largest diversified centers of excellence portfolio. With a fully integrated medical value chain, Cleopatra streamlines the patient journey, from diagnostics to recovery, making it the country's healthcare provider of choice. This approach, coupled with a holistic network of 10 diversified centers of excellence, is able to achieve substantial case mix optimization. The group also continues its development of the medical value tourism business line, operating services such as IVF and rehabilitation targeted towards international customers, capturing the increasing global medical tourism interest, with Egypt having lower service costs to its regional peers. All these factors drive an expansion average revenues per occupied bed over our forecasted period to reach an expected £15.2 million by 2020.
Cleopatra's expected top-line CAGR of 24% will largely be fueled by flagship ramp-ups in East and West Cairo, leveraging leasehold agreements which catalyze Cleopatra's evolution into becoming an asset-light player. Due to their organic growth strategies in the past, leveraging greenfield and M&A, Cleopatra has delivered a ROIC slightly lower to its regional peer average of 14%. But we have conviction that management is well equipped for value accretion, with the asset-light approach expecting to deliver a 5 times reduction in capex per occupied bed, with Haven in West Cairo exhibiting a faster ramp-up, beating consensus estimates and earning over £248 million of revenue in 2024. Cleopatra's flagship facility in East Cairo, Sky Hospital, has launched in the first quarter of 2025. Funded by an estimated £1 billion of new debt, this drove Cleopatra's debt-to-equity ratio to a highly leveraged position of 86%, higher than the regional sector average. Its debt servicing coverage has also lagged slightly behind its peers in 2024, having only had an interest coverage ratio of 9.5 times. However, with 2024 outlining the peak capex year for Cleopatra, we anticipate deleveraging down to an approximate 11% debt-to-equity ratio. And with anticipated cuts to the central bank's corridor rates, an interest coverage ratio averaging at 18.2 times is anticipated over our forecasted period. Moreover, Cleopatra's strategic approach to operational efficiency should continue to pave the way for margin expansion, and building on interest rate cuts, Cleopatra's unique cost profile, and enhanced service line management, we anticipate moderate margin expansion across the board, with Cleopatra continuing to surpass its peers in profitability. We anticipate all these factors to materialize into an increasing FCF conversion rate averaging 39%, with a robust ROE to COE spread. We additionally anticipate increasing free cash flow and dividend yields as Cleopatra becomes a leaner, more efficient business and approaches maturity.
On the back of the flotation of the Egyptian pound came increasing foreign investor appetite. As a result, Egypt saw a 27% increase in mergers and acquisition volumes, increasing cross-border deals and half of all healthcare acquisitions in the Middle East. And with investors flocking to safe havens amidst rising concerns of a global recession, Cleopatra stands tall. With a negative downside beta and its resilience against market disruptions, its structural strength in the market uniquely positions it as a defensive stock against global market risks. And with its institutional shareholders approaching their investment tenure, we anticipate their lobbying for private placement in the future. Therefore, we believe Cleopatra emerges as a prime acquisition target, implying potential exit opportunity upsides. The quantification of this is reflected in our EV to BED multiple, highlighting Cleopatra's capital-intensive replacement costs, yielding an implied value of £12 per share, and our precedented transaction analysis, yielding a value of £16 per share. We also conducted a reverse DCF model, finding that the market currently prices Cleopatra in anticipation of a conservative 13% top-line growth rate, which we believe does not adequately reflect its growth potential, presenting a substantial mispricing of Cleopatra in the market.
To evaluate Cleopatra's ESG practices, we built a framework based on these leading data providers and on-ground insights, which yielded a 7.7 out of 10 ESG score, however slightly lower than the peers. Cleopatra has first implemented initiatives to reduce its emissions, including LED lighting, upgraded heating and ventilation systems, and chiller enhancements. In addition, it has outpaced its peers by reducing water consumption by nearly 14% and strong waste reduction initiatives. With women comprising over 60% of its workforce, Cleopatra preserves the industry's female inclusivity. Through mandatory health and safety training programs, it fortifies its workplace and minimizes risks. However, due to lagging socioeconomic development initiatives, it has scored less than its peers. Cleopatra's 13-member board includes 4 independent members and only 2 executive directors, ensuring diversity, objectivity, and industry expertise. It aligns executive compensation with stakeholder interests, which historically represented 17% of net income and a 20% forecast. And with aligned peer scoring among its peers, Cleopatra is well positioned for sustainable growth.
At a 44% upside, our weighted valuation combining a DCF model with forward-looking multiples points to an intrinsic value of £11.73 per share. This is further validated through our use of free cash flow to equity, precedented transactions, and replacement cost, using EV per BED. At a 90% weighting, our 5-year DCF model yields an intrinsic value of £11.85 per share at a 45% upside, utilizing a 7% terminal growth rate. And to account for anticipated interest rate cuts, a converging market risk premium, and Cleopatra's deleveraging credit profile, we employed a moving WACC, with a base value of 31.83%, a terminal of 15%, and a net ESG adjustment of a premium to the discount rate. And to isolate the intrinsic value of the 2 new flagships, we conducted a sum of the parts analysis, finding that Sky currently contributes 9% following Haven's 15% contribution to the overall fair value. We further conducted a Monte Carlo simulation and sensitivity analysis on our financial and valuation assumptions, finding that they consistently point towards our buy recommendation. And at a 10% weighting, our relative valuation, including 10 peer comparables, yields an intrinsic value of £10.66. Analyzing the EBITDA and PE ratios pre and post the market disruptions of the 5th of April, finding that the implied upside used to be 60%, transforming to a 31%, showcasing Cleopatra's deep discount to peers and higher.
Our valuation is subject to certain risks, the most notable being the repricing of insurance contracts, which could decrease revenue per patient and increase receivables, the churn of medical personnel, which could decrease brand equity and trigger a salary increase, and mounting competition incurring market share losses. However, Cleopatra's brand equity, reputation, and bargaining power mitigate these risks, and there is still a significant upside even after quantifying them. Thus, we, the American University in Cairo, reiterate our buy recommendation. So join us in generating a 44% upside by investing in Cleopatra. Thank you.
Thank you. We will now move on to the Q&A portion. Judges, you may now turn on your video if you haven't done so already. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Hello, I will take the floor. Thank you for the presentation. Could you please elaborate a little bit more on the role of government in Egypt healthcare sector and its impact in terms of growth, pricing, opportunities, and risks for the company?
Okay, so the government incentives play a huge role in driving the demand growth in the Egyptian healthcare market. as part of its reform program, which is supported by the IMF, they're actually facilitating privatization when it comes to the private sector, and by implementing the new investment law, as well as having public-private partnerships, all of this facilitates privatization, which Cleopatra could capitalize on since it is one of the private healthcare providers in the market.
Okay, thank you for the presentation. I would like to ask about the average price assumptions on page 71. How did you come up with these positive and optimistic figures?
Sorry, could you please repeat the question?
Can you please repeat the question?
Can you hear me?
Yes, can you
okay.
please repeat the
Okay,
question?
so if you take page number 71, where you explode the revenues of the companies by sector, would you please tell me the narrative behind the assumptions on the estimation of the average price per each sector of the company, please?
Thank you so much for your question. I'd be happy to take this one. We wanted to explore two sides to the revenue forecasting model. We wanted to explore the flagship pricing and the differences between different facilities that Cleopatra operates, where the flagships and the new flagships both operate premiums, with the new flagships operating a 15% premium on the existing flagship in East Nasr City, which operates the highest current average revenue per bed. However, we wanted to also take a look at inpatients, outpatients, and the different pricing for those. And we chose to remain conservative by pricing them with inflation, as that's what Cleopatra has done in the past. Cleopatra has also historically been able to experience high pricing power, being able to transfer its entire cost burden of inflation onto their consumers and remain very, very sticky with their gross margins over historical years.
To further add to my colleague's point, the vast majority of Cleopatra's patients are actually insured patients, which decreases the elasticity of demand when it comes to price increases. And thus, it allows Cleopatra to increase their prices with inflation.
Okay.
Hi, this is Asad. I have a question on the valuation, and if you can explain the thought process behind using the percentage for DCF 90% and ESG premium of, I think, 0.1, if I remember correctly. So what is the thought process behind those assumptions? Thank you.
Thank you for your question. Our valuation weightings are at 90 and 10%, with the majority allocated to the DCF model. And this was a result of us recognizing that Cleopatra has a discrete and unique assumptions regarding its evaluation to becoming an asset-light player, such as capex, debt reduction, working capital, and our valuation assumptions, such as Egypt's unique cost of capital to generate a reliable valuation. Our 10% allocation to the comparables is because Cleopatra is pioneering in the semi-asset-light model in Egypt. We needed to compare it to other similar hospital groups that already employ the semi-asset-light model, which were mainly found in the GCC, South Africa, Thailand, and Turkey. However, we did not give it a higher weighting due to the massive cost of equity distortions between Egypt and the comparable countries due to the high risk-free rate that Egypt manages, as our hurdle rate is at 30% currently.
And to answer your second question about the ESG premium, so firstly, we evaluated ESG scorings for Cleopatra compared to its regional peers on each pillar, and where this is where we found that Cleopatra had an overall net impact of 0 to our direct discount rate. However, because we recognize ESG's importance to Cleopatra's valuation and to any financial company, especially since a large number of its free float investors are foreign-based, so we decided that we wanted to implement also a premium to the beta, and this was generally to account for Cleopatra's lack of ESG disclosures. And since ESG disclosures were not usually mandated in the Egyptian market, and Cleopatra's lack of disclosures, we just implemented this premium on the pure play beta just to account for the ESG climate in the systemic risk of the stock itself.
Okay, thank you.
Okay, if I may, I also have a couple of questions on valuation. The first one was on the DCF. You use a 7% terminal growth rate, which looks a little bit high. Can you just tell me how much of your intrinsic value from the DCF is from your explicit forecasting period and how much is in the terminal value? And the second one is on the transaction multiples that you used. It looks like the average is very skewed by a couple of transactions in Malaysia and China, if I remember correctly. Actually, from your summary of the evaluation methodology, it looks like that using the lower end of the transaction multiples, you could have a lower price, a lower intrinsic value than today. So what makes you think that this company could be taken over or acquired at a premium to the current price?
Thank you for your question. Our terminal growth rate, it's a nominal value derived from the upper bound of the CBE's latest publication of their long-term inflation target, the mid-corridor. We chose this upper bound as it also reflects the IMF forecast long-term inflation rate of 7%. We chose it to reflect our sticky view on CBE targets based on historical economic performance. Additionally, we chose not to incorporate any real growth figures in our terminal value to remain conservative, since we are modeling Cleopatra into maturity, assuming maximum utilization by 2029 and no new materialized expansions on the horizon.
To answer your question about the precedented transactions, if we go back to the table that we have shown previously, you could see that, yes, some companies may skew the average a little bit. However, you would also see that the average is exactly the same multiple that the only hospital sold in Egypt was acquired at. Moreover, we believe that even though the lower bound could decrease our target price massively, that lower bound was based on much smaller hospitals that do not have Cleopatra's synergies, their economies of scale, or their potential growth in the market.
Thanks.
Hello again. How are they leveraging digital health or telemedicine services, and how it's reflected into the financials?
Can you please repeat that question?
How are they leveraging digital health or telemedicine services, and how is this reflected into the financials?
All right, thank you very much for that question. So currently, Cleopatra utilizes both ERP systems and health information systems, both of which decreased 70 million Egyptian pounds from their COGS, which is approximately 4% of their value.
Okay, if we have time, I have a question on debt, because you said that they are at a very high leverage ratio right now, but you expect the company to deleverage very quickly in the future. Is that coming from free cash flow generation? And how does that fit within acquisitions, CapEx, dividend payments in the future?
Thank you so much for your question. The point is, it is very true that Cleopatra is currently very highly leveraged. We have also looked at their relationship between their CapEx, their capital expenditure, as well as their debt reliance in the previous years, where we found that, sorry, give me just 1 second. Where we find that CapEx was usually very, very heavily tied to taking on leverage, except in years earlier on in 2019 and 2020, where interest rates were very unstable and investors were hesitant and apprehensive to take on new debt. With Cleopatra having the peak CapEx year for 2024, this is the CapEx, the highest leverage point in their debt, since they took out the £1 billion loan to finance Sky Hospital. However, the capitalization of this loan is expected to occur with the launch of Sky Hospital, and only is expected to launch to capitalize after Cleopatra and Sky Hospital starts to ramp up, meaning that there will be an influx of cash in the market, in the company, to where Cleopatra will be able to finance this debt. Additionally, Cleopatra's working capital is at a very advantageous point where they have a negative cash conversion cycle, so they're very easily able to have cash generation given their superior bargaining power and negotiation terms with their suppliers, having a very high days payables on hand. And they're, in addition to their intention to not have any M&A or greenfield acquisitions or expansions in the future, and to move forward solely with the semi-asset light model. And even with the semi-asset light model, they have not highlighted any materialized expansions over our forecasted period or in the near future. So what we did was to assume deleveraging with the decrease in capex.
To further add to my
Please.
colleague, our debt forecasts are also expected to decrease due to Egypt approaching the peak of, or approaching the last stage of the interest rate cycle, which allows us to anticipate interest rate cuts and thus decreasing in interest expenses.
I have two questions. I don't know if we have time to answer them. One is about the utilization of the hospitals in the slide, which breaks down hospital within the company. There is an utilization rate which is at an average of 60%. I would like to know if you think this is a good figure compared to the peers in the industry. And also, if you can elaborate a little bit about the semi-light and light model strategy of the company. Thank you.
Well, in terms of utilization rates for the general market, we would not recognize that 60 to 70% would be maximum utilization. But we have to account that for healthcare sectors overall that operate healthcare facilities, their maximum utilization rate leverages when patients are actually occupying the amount of beds that are currently available for use by the company. Since certain amount of beds are usually under maintenance or reserved for severely emergency cases, such as ICUs and so on. But for inpatient beds and general clinics, or inpatient utilization is what drives our valuation the most. 77% would be a very standard assumption for what would be a maximum utilization rate for a company like Cleopatra.
Okay. And what about
could
the
you
light and
just
semi-light?
repeat the second part of your question, please?
The second part is related to the light and semi-light model that the company is introducing to reduce capex expenditure and streamline financial structure, and also about the EBITDA
Okay, so
share with the lessors also.
the semi-asset light model, it can be implemented through leasehold agreements, and it requires 3 times less capex than the usual traditional brownfield or M&A acquisitions. And it allows for quicker expansion, and it allows Cleopatra to expand its network much faster than with the traditional business model. And with the semi-asset light, this is the semi-asset light model. And with the asset light model, it can be implemented through management agreements, as can be seen through Mumtadda, and it requires 0 capex costs, and its impact can be it can be easily expandable to other markets, and it's easily scalable.
And the asset-light model that they are currently utilizing in Mumtadda, it actually allows them to have an FX risk, a hedge against FX risk due to the current instability of the Egyptian economy.
Okay. Thank you.
That is time. Thank you, American University in Cairo. At this time, the judges will take a few moments to collect their thoughts and make notes before the next university is brought in. Thank you all. Hello, BI Norwegian Business School. At this time, please launch your presentation and make sure everything is working properly.
Good afternoon. We are from BI Norwegian Business School. We issue a sell recommendation for Equinor with a target price of $20, implying a 15% downside. The market overvalues its aggressive push into renewables. This shift erodes shareholder value due to 3 critical factors: Equinor's significant departure from core competencies, resource constraints inhibiting growth and profitability, and first-mover disadvantage in low-carbon solutions. Equinor is a Norwegian state-owned energy company with the Norwegian government holding a 67% stake. Equinor operates along the entire energy value chain in around 30 countries. It remains a leading oil and gas producer, accounting for 70% of Norway's output while heavily investing in renewable projects. Despite significant investments in offshore wind, hydrogen, and carbon capture and storage solutions, Equinor remains dependent on oil and gas, which still drive 90% of revenues. Equinor is a key oil and gas supplier in Europe, maintaining a strong position in an industry with high barriers to entry. Equinor's expertise lies in offshore oil extraction, where decades of experience have given it a competitive edge. Equinor's rapid transition into renewables comes at a costly first-mover disadvantage. Unlike competitors waiting for cost efficiency and regulatory clarity, Equinor is committing 50% of capex to renewables by 2030. Oil and gas will remain relevant far into the future, especially in developing areas, with non-OECD markets relying heavily on oil and gas for industrialization and energy security. Equinor is entrenched between oil giants, delaying the renewable transition for higher returns, and pure-play green firms leading the renewable sector. This misalignment weakens profitability, where Equinor forgoes its core competencies, which reinforces our sell recommendation.
Our first thesis hinges on Equinor's drastic departure from core competencies, marking a rapid diversification of their business. Global energy demand is expected to rise by 47% by 2050, with oil remaining dominant. This aggressive pivot is in opposition to clear trends. Rather than capitalizing on this opportunity utilizing its expertise, Equinor is leaving behind its core competencies to chase a less profitable green energy revolution. The second component of our sell recommendation is the self-imposed resource constraints Equinor has dumped on its shareholders. As investments in oil and gas take a back seat, so do investors. Equinor plans to increase capex to renewables from 20% up to 50% in 2030. However, despite this extreme level of investment, the energy generated from these investments is only expected to reach 10% of total energy output as a best-case scenario. This drastic strategic realignment is not one shared by US-based peers. Our third investment thesis encompasses Equinor's first-mover disadvantage in low-carbon solutions. We believe that there has been a substantial underappreciation of costs and ever-elusive benefits to the company. To further drive home the managed decline at hand, the return from these green investments is only 4 to 8% real return. This is a stark contrast to the typical project, which boasts returns of around 30%. Therefore, most oil and gas companies have chosen to delay their entry. This creates a competitive landscape where Equinor, as a first mover, bears disproportionate financial and operational burdens.
Equinor excels while operating in a high ESG risk industry, attempting to balance traditional energy production with increased green energy investments. A 20% cut in capex for green initiatives reflects profitability concerns, as the free money flow into ESG-focused investments has slowed significantly. This highlights the costly nature of moving away from Equinor's core competencies, which remain in high demand. Environmentally, Equinor aligns closely with Norwegian and global climate goals, setting ambitious targets like achieving net zero by 2050. It has cut emissions by 30% and lower carbon intensity to 6.7 kilograms per barrel of oil equivalent, which is well below the industry average. Though this leadership surpasses many peers, returns and profitability will suffer. Equinor has allocated $3.4 million for labor standards, human rights, and community support in Brazil, Nigeria, and Tanzania, with 25% voluntarily contributed, indicating a strong commitment towards social initiatives. Governance is heavily driven by the Norwegian government's 67% ownership stake in the company. While this allows for greater transparency, it also induces strategic frictions as the state seeks to prioritize objectives other than profitability. Further, executive compensation is tied with CO2 intensity, shifting the focus away from maximizing shareholder returns.
Historically, Equinor has had highly volatile revenues due to COVID, the Ukrainian war, and commodity prices. We predict revenues returning to 2018 levels, adjusted for projected oil price growth, and this forecast is based on a loss of market share with Russia returning to the European market. Deviations from core competencies and increased capex ensures a loss of competitive positioning against Russian players, particularly with the US now increasing competition in Europe. Oil prices are projected using a 50% quantile regression model, ensuring low bias from highly volatile prices, and decreased margins are caused by increased investments in renewables with lower real returns. Oil and gas assets have high EBITDA margins due to strong pricing power and have relatively low operating costs once developed. Meanwhile, renewables have lower prices that are fixed by power purchase agreements, while operating and maintenance costs are persistent. Increasing capex also increases depreciation, reducing the EBITDA margin and the net profits. According to Equinor's capital market updates, quarterly dividends are set to rise by 2 cents per share annually, with share buybacks continuing. Total shareholder payouts will decrease yearly from $9 billion in 2025 to $6 billion in 2030. Increasing EPS and DPS come from decreasing shares outstanding, disguising corporate mismanagement through the illusion of financial strength despite the weakening underlying cash flows. Our DCF valuation has an implied share price of $20.2, a 15% decrease from today's share price April 10th. We use a WACC of 8.27% and a terminal growth rate of 2.5%. This is a perpetual cash flow model, basing the terminal value on the final cash flow rather than an asset multiple. And in our model, constrained cash flows primarily come from increased investments in less profitable renewable projects, causing a low valuation. In our relative valuation, we have 3 peer groups for Equinor's different markets. The peer ratios are computed by weighing the different peer groups, respective to Equinor's stake in the market, and the applied share prices can be seen in the football field chart. Overall, our relative valuation supports our sell recommendation. We also conducted a Monte Carlo simulation with 1 million trials by stressing the oil prices, the EBITDA margin, the WACC, and the terminal growth rate. This resulted in a median price of $20, with 47% of outcomes falling below our target price and 68% falling below the historical share price. With both the median and the mean close to the target price, this simulation signals low model sensitivity to oil prices, which are otherwise assumed stable in the long term. We further conducted a bull and bear scenario analysis and found around a 6% chance for either scenario. The primary triggers for these scenarios are changes in oil prices and margins caused by cost changes in current operations. Decreases in capex might further increase the optimistic outlook in the bull case, a scenario becoming more likely given recent shifts.
We recognize 3 key risk factors reinforcing our sell recommendation for Equinor. First, Equinor's performance is tightly linked to oil and gas prices, with an 89% correlation. When oil prices fall, Equinor's ability to fund capital expenditures weakens. Despite this, Equinor continues to allocate significant resources to renewables, a segment with much lower returns. This misalignment threatens profitability. We believe Equinor underestimates this risk, potentially jeopardizing future profitability and shareholder value. Second, the shift to renewables introduces execution risks. While this transition aligns with long-term energy trends, it still heavily depends on government incentives, green financing, and policy support.
1 minute remaining.
If global climate goals shift or emerging technologies outpace Equinor's execution, financial setbacks could follow. Third, regulatory pressures are mounting. Rising CO2 costs and strict climate policies, especially in Europe, put Equinor at a disadvantage compared to peers. These constraints squeeze margins and add uncertainty to long-term profitability. We therefore restate our sell recommendation based on Equinor's departure from core competencies, resource constraints, and first-mover disadvantage. For investors, this highlights a clear misalignment between strategy and shareholder value. Thank you. I will now take your questions.
Thank you. Judges, you may now turn on your video. The Q&A portion will last a minimum of 10 minutes and a maximum of 15. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Hello, thank you for the presentation. How does Equinor manage political risk, especially being majority owned by the Norwegian state? Is there risk of government interference, or is it a stabilizing factor?
Certainly. So the Norwegian government ownership acts as a double-edged sword. On the one hand, it does provide stability, as you mentioned. On the other hand, it can also lead to strategic misalignment, as we have seen with managerial incentives now being tied to objectives other than profitability measures, such as carbon intensity. This can create a misalignment in terms of the direction of the firm, and we have seen profitability suffer as a result, which can signal for shareholder-centric investors that it is better to look elsewhere, which aligns with our theses and sell recommendation.
Seeing this from another angle, there's also this traditional view that governments are always worse than the private sector at managing financials and pretty much anything that the global sector or the private sector can optimize. And when it comes to Equinor, or to the Norwegian government, it has historically, in the past 2 years, managed to create substantial returns on the oil front assets. And this is considering that they've divested from a lot of oil firms and have divested from tobacco and specific firms like Walmart. So we do not believe that the government is a negative influence per se, but its influence on the firm is also limited by the Norwegian governor model or governorship model.
Okay, if I may, just to be clear, your sell recommendation is based on your business analysis, the 3 risks, problems that you highlighted, or is it also based on your valuation? Because doing a DCF analysis, a DCF model, sorry, for an oil company, it's really, really tricky. And your dispersion, your range is also quite wide. It goes from the $11 to $32. So just to summarize, is your sell recommendation based on the companies doing everything wrong, or a lot is put on valuation?
Most of our decision actually comes from these economic model or these economic macroeconomic factors. So it's not really based on the models so much as a model supporting our thesis. The biggest influences really is how we've assumed, like which direction we've assumed the market is going to move in and how these macroeconomic factors are going to affect Equinor. And then we've modeled the DCF analysis with this in mind and tried to take into consideration some different possible outcomes in these macroeconomic factors in the bull and the bear cases, which is why there's a very big range, especially due to the sensitivity of the oil prices.
Hi, this is Asad. I have a question on the valuations. When I see different numbers on the valuation slides, the starting point is your target price is 19.8. Can you explain that on what basis? Because there are different numbers I can see under different scenarios. On what basis actually 19.8 was pegged? Is it a midpoint number, or is there any weightings used? So what was the thought process behind the 19.8 target price?
So we prepared 3 entire different financial statements for the bull case, the bear case, and the base case. And the number 19.8 is based entirely on the DCF price. However, we use other valuation metrics such as the DDM valuation and the relative valuation to ensure that this picture painted by the DCF analysis isn't too off, so to say. And the reason we've chosen to use primarily DCF analysis is because it paints the most complete financial picture and allows us to control most of the inputs and the assumption that goes into the model. As for the base and bull and bear case, we've mostly considered how these different macroeconomic factors impact the costs and the margins, and this kind of like goes down and impacts the financial statement and the free cash flows further down the line.
And have you taken the impact of ESG scores on your valuation?
Certainly, we have taken the impact of ESG scores on our valuation through our 3 thesis points, where Equinor's significant departure from core competencies, resource constraints, and first mover disadvantage. And we have aligned this ESG scorecard against Equinor's peers and thought of it into our valuation aspect.
I would also add on to that critically, if you could pull up the ESG fund flows. Again, we've sort of evaluated this from two perspectives. An investor looking for a more shareholder-centric viewpoint, as well as a more stakeholder-oriented perspective. And so one thing that we've seen is that overall ESG support and investment has slowed, specifically in key markets such as the US, as we can see here in the chart. Now, crucially here, Equinor does outperform its peers in ESG aspects. It's not necessarily the highest performer, but it does outperform. However, it has been lagging behind in other aspects, notably profitability measures, as we mentioned in regards to our thesis and the overcommitment towards green factors.
Okay, thank you.
When you say that resource constraints are inhibiting growth and profitability, are you referring to the fact that they are putting a lot of money into this diversification strategy with unknown, probably low returns? Or are you talking about how they are going to fund their CapEx? And if it's the latter, can you discuss the debt situation currently and if they have any other sources of funding in the future, including equity from the state, from other investors, or whatever?
Certainly. So by this statement, we're referring to the former, essentially their allocation of their existing CapEx. Now, specifically, we see here again, the key aspect as well is the scale of the increase in CapEx towards renewables, as well as the very abysmal results, both in terms of returns, which again is in the 4 to 8% range, real returns, which is far lower than the typical oil project at 30%. However, the other aspect is the forecast of 10% overall energy production from green investments, again, is a best case scenario. And to provide some perspective on that, that number currently sits at 0.63% of total energy output from the company. Now, even with already substantial investments, it sits at this level. And so even with the 50% CapEx, we don't see that going much higher. So essentially with this CapEx, in our opinion, the optimal position would be to allocate to financially attractive projects, potentially in the international portfolio, which is something that Equinor has been looking to expand upon, specifically in key markets such as the UK, Angola, and Brazil. Alternatively, if such projects are not found, we can also see opportunities to return more of that money to shareholders, increasing their share buyback and dividend program, which we believe in terms of a shareholder-centric model would be the best case for the company if the right projects do not arrive.
Thank you.
As far as if I'm not mistaken, as far as I see from the presentation, despite your narrative of low margin renewable investments, it seems that the company will keep stable margins close to the long-term average in the future. How would you comment on that?
Yes, the reason that we've had fairly stable margin in the model is because we have, if you could bring up the oil price forecast, please, we have projected a positive growth in the oil market. So these increases in the oil prices are kind of weighed against these less profitable assets eating up part of the portfolio.
One question on my side. Do you think Equinor's shift to renewables is rather a real strategy change, or is it an answer or a compliance issue to existing and upcoming regulations?
I think it would be a mix here, primarily, again, driven by the government ownership and sort of a prioritization of non-profitability measures in an attempt to align with more green energy trends. Again, there are certain potential arguments to be made on the profitability side in certain cases, again, tying back to the regulation that you mentioned, specifically in terms of addressing carbon taxes. So that is one aspect of potential renewables that can be successful in moderation, of course. So at far, far lower levels than we're seeing now, essentially using offshore wind to power their existing facilities, sort of attempting to leverage their core competencies to an extent, thereby lowering the carbon intensity and also their emissions, carbon taxes, etc. But again, overall, I think it is something that they are pushed to do, not necessarily in the benefit to shareholders. We've seen a similar instance play out with BP, where they were at a very similar trend line to Equinor in terms of their portfolio allocation. This is also one of our core peers here. And recently, due to activist pressure from a US-based hedge fund, they have actually made substantial cuts to the renewables, again, at the pressure of shareholders, trying to get them back to core competencies and increase their return potential.
What assumptions have you made on the future price of oil, just to do your DCF or any other analysis?
So the way that we projected the oil price is that we use something called a median regression model or a 50% quantile regression model. And the reason we've done this is because instead of looking at the levels of the oil prices, it's instead looking at whether it's above or below a median. And this makes it significantly less sensitive to these extreme levels during the Ukrainian war and during COVID. And this creates, I mean, you can see the trend line on the left here. It's roughly equivalent to a 3% year-on-year increase in the oil prices. And it's going to be around 70 3 years from now. So it's basically an increase of about $5, I believe, from current prices.
Okay, but as you can see from your own chart, it's very volatile. So just making assumptions 3 years out, it's very difficult. Have you compared your DCF, your assumptions with the future curves for oil? Is there a kind of break-even price for oil that would make you change your recommendation? Say the oil goes to 120, that will definitely change your DCF, right?
Yes, certainly. If the oil price growth is larger than we have projected, we have made a financial or a size analysis on that. If you could bring up the risk slide with the evaluations, we estimated that a roughly half a deviation change in the increase in the oil prices will affect the valuation by roughly $8.5. This is slide 19, please. Yeah. By $8.5, and half a deviation is approximately $5. So if you increase by $5 more than what we expected, that is, then we could see in the future it would change at least to a whole recommendation, probably not a buy recommendation until a full standard deviation change.
Thank you.
But we have also stressed the oil prices in the Monte Carlo simulation, and we still, average a median out to 220.
If there are no further questions, we can go ahead and end the Q&A. We have about a minute left. Thank you, BI Norwegian Business School. At this time, the judges will take a few moments to collect their thoughts before the next university is brought in. Welcome, International University of Monaco. Please launch your presentation and make sure everything is working properly.
Welcome. Thank you for joining us. My name is David. I'm here joined by Max, Samira, Angela, and Dorian from the International University of Monaco. And today we're going to be presenting our analysis of Caring, the French luxury conglomerate. In our presentation today, we're going to be displaying a hold recommendation because in our eyes, we believe that the short and medium-term risks offset the current long-term, potential benefits that Caring can provide.
Caring's portfolio includes some of the most renowned luxury brands, including Gucci, Saint Laurent, and Bottega Veneta, which in sum made up more than 3/4 of the total revenue generated in 2024. Revenue has been under pressure recently, dropping another 12% down to roughly 17 billion. Such has also been reflected in a slight retraction in the market share across the soft luxury goods market, which is the segment that Caring is most exposed to. However, not enough to challenge its place second only to LVMH. A bright spot in Caring's portfolio was Caring Eyewear, a segment which expanded more rapidly than the group overall, both in revenue and in market share, now closing the gap to its closest competitor in the market, Luxottica.
Personal luxury goods declined 2%, driven by economic and geopolitical uncertainties, particularly in regions such as China, with a low consumer confidence and a struggling GDP growth, in the US, with the current administration causing a trade war with China, and high inflation rates puts financial pressures on aspirational consumers, while strong growth in Japan was not strong enough to offset overall decline. However, the market is expected to grow modestly by 2030. Such pressures on consumers has also shifted their preferences within the product segments, with eyewear and beauty showing positive gains, while declining soft luxury products exposes Kering to market risks.
As a result, we issue a old recommendation. Why? Three main reasons. Firstly, the Gucci declining sales highlights the fragility of Kering. It forces Kering to take corrective action. Secondly, the current turnaround strategies are not addressing the underlying problem. Thirdly, Kering expansion into beauty and eyewear aligns with market trend, but this initiative requires time to impact revenue and margin.
First point is that Kering has become overexposed to Gucci and more broadly on the soft luxury market. Gucci's lump shows just how much the group's success relies on this one brand to keep up with industry peers. We believe this drop in sales points to a simple issue: a disconnect between management vision for their brands and what consumers actually want. It's not like there's a rooted flaw within their brands. Instead, the gap lies in executed decisions being out of sync with the market. Over the past 2 years, Kering, fundamentally a retail group, has aggressively invested in real estate. To us, it feels like they're leaving the lane without any clear direction. More recently, our confusion grew as they began reshuffling those assets, likely to unlock cash and address liquidity challenges. One example is the Arden joint venture, freeing up more than 800 million from a building bought just 2 years ago in Paris. At the same time, the dividend payout was cut to boost capex, trying to revive struggling brands.
In addition to that, financial years 22 and 23 were characterized by slower moving inventory, with days of inventory at hand reaching almost a year in 2023. Inventory turnover did improve in 24. However, it was mainly due to operational measures taken to actively reduce inventory at hand rather than addressing the underlying issue, which was a decline in sales and an alienation of its customer base. Historically speaking, often the creative directors of luxury brands alongside the CEOs have proven to be the most pivotal force in turning around sales. Kering has acknowledged such, and the decline in sales has triggered a number of leadership changes across its houses. Most recently at Gucci, with its creative director Sabato De Sarno parting with the brand in February of this year, and Demna, previously at Balenciaga, being announced as the new creative leader of Gucci scheduled to join in July. While a change in leadership was widely anticipated to turn around the brand in the medium term, it does expose Gucci to a lot of short-term uncertainty, with collections in the interim being led by an in-house design team and the announcement of Demna being overshadowed by a considerable negative market reaction.
In an additional effort to increase revenues, Kering's strategy to reduce wholesale is already visible with increasing retail revenues across its houses. While this strategy has its benefits, such as pricing power and brand exclusivity, the risks associated are predominantly short-term, and this creates an asymmetrical risk-reward timeline. Nonetheless, results are yet to be seen as Kering is still struggling with declining revenues.
Kering Eyewear is a prime example of how the group can successfully enter and dominate a new luxury segment. Since launch, Kering Eyewear has grown rapidly, proving the group's ability to scale in a non-traditional segment. Both industries are brand-driven, high-margin, and resilient to economic downturns. And in last, partnering with an established market leader ensures operational strength and credibility.
In addition to the expansion into luxury eyewear as well as beauty, we believe that the revitalization timeline at Kering will take about 3 to 4 years. So until 2028 to 2029, until Kering can get back to a normalized capital structure where it can return to its core business model of acquiring high-value luxury brands. Now, in our opinion, we believe that the acquisition of Valentino would be the logical next step, because in July of 2023, Kering previously acquired 30% stake in Valentino with an option contract to purchase the remaining 70% by 2028. So it would fit perfectly within this timeline. Now, we believe that due to the synergistic benefits that Kering can provide, they can increase Valentino's current EBIT margin from 7.3 to that of the other houses at 13.4, and really provide that next step value creation for Kering in the long term. Now, while there are these potential benefits that could happen that we've laid out, we believe that the short and medium term risks are still there and they still offset these potential long-term benefits that could happen.
Upon completing our ESG analysis, Kering emerged as a leader among its peers in governance, both in diversification and fair pay. Its strong governance pipeline is further supported by the creation of the lead independent director to counteract Francois-Henri Pinault's dual CEO and chairman position.
luxury, as much as sustainability, reputation is just about everything. And Kering has made it a pillar of their strategy. The report Scope 1, 2, and 3 emissions and hold a AAA ESG rating for the second year in a row. But leadership in reporting does not mean leadership in impact. The EPL transforms environmental impact into monetary costs. It's an innovative metric, but not perfect. Because when primary data is missing, Kering relies on secondary sources. That opens the door to cherry picking, as well as a lack of third-party audit. On the other hand, Scope 2 emissions, which account for a staggering 99% of the group's overall carbon emissions, are measured by tons of CO2 over millions of gross margin, meaning that if the company were to get more efficient in terms of margin revenue, the metric would still go down without reflecting an actual carbon emission cut.
Through our analysis, we adopted a blended sensitivity analysis approach, weighing 80% to our discounted cash flow, which is bifurcated between a terminal growth and then equally on opposite side an exit multiple. Additionally, we also used 20% from relative comps evaluation using the assumptions you see on the right hand of the screen. Now, given that the luxury sector historically shows significant dispersion in trading multiples, which is pretty much influenced by brand perception a little bit more than fundamental performance, we placed a greater reliance on that digital cash or the discounted cash flow model, which gives us a little bit more control over the critical assumptions for Kering, such as future cash flows, being able to monitor their debt levels, given that they had a recent downgrade in their credit rating. Additionally, synergies such as the Valentino acquisition, which we forecast, and then finally, terminal value calculations. Now, while relative comps provide a helpful benchmark for market reasonableness, it's not a core driver of evaluation. Given the current internal challenges and economic uncertainties that are unfolding right now, we believe that the stock is fairly priced in relation to the current close. We do not believe that the current share price offers an attractive entry point for investors at this time.
Alongside the valuation, we have identified two key downside risks impacting Kering, first of which being the market implications under the evolving US tariffs. The US announced new tariffs in the beginning of last week that entailed baseline levies across the board, as well as additional tariffs on main trade partners, including the EU. The risk of Kering being directly affected in US sales has been deferred with the implementation of a 90-day pause on such tariffs. However, Kering and some
remaining
overall remain highly vulnerable to an ongoing trade war between the US and China. Secondly, the consumer risk, which is particularly felt at Gucci. Following a period of sales decline, the brand is left open to significant short-term uncertainty given its recent leadership changes and negative market reactions to the announcement of Demna. Given the high impact of some of the risks we have identified, we already priced them into our 12-month target by their weighted probability.
In conclusion, despite Kering's long-term growth potential, we believe that the near-term macroeconomic tensions, coupled with brand repositioning challenges, as well as leadership uncertainties in the short term, support our view that a hold position is the most prudent in the current economic environment. Thank you for your time and consideration.
Thank you. We will now move on to the Q&A portion. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Hello, thank you for the presentation. How do you integrate ESG performance of Kering into financials and valuation? And because they have a AAA CDP score, what tangible steps has Kering taken to reduce environmental impact across its operations and supply chain?
Of course, I'd be happy to take that. Samir, if you could go to, yes, or the evaluation scenarios, please. So how we approach this with the ESG risk is that we weighted it at a negative 5.56. So Max is going to talk a little bit later about the interworkings of the ESG, but given the high probability but low impact of the risk that we foresaw, we discounted it only about negative 6% in terms of the valuation perspective. So I just wanted to give that holistic view. And then Max, you want to take it over?
If we could please go to Appendix H8. So the major risk that we taken into account in the valuation regarding ESG is labor practices in the supply chain, particularly in the Italian subcontractor network, such as Imprato, which is the biggest European textile industry. And we believe this pose quite a threat regarding reputation risk, but as David just said, they have low impact. in terms of what the company has done to actively reduce their environmental impact. If we could go to Appendix H7, please. As you can see here on the graph, the company is actively managing trying to reduce their environmental impact and make sure that their goods are supplied ethically and according to industry standards. We can see quite a sharp decrease in leather goods, which is something that the company has to definitely improve on, but overall an improvement across the board when it comes to sustainable sourcing for these materials.
I have a question on your final recommendation. Is the old based on the business analysis? There are troubles on the horizon in the short term. You don't believe in the restructuring of the company, or is it mostly based on your valuation, which is just 5%? There is just a 5% upside.
So I'd be happy to take that. So I think we took both into account, but from our perspective, we believe that it's a lot more of a business risk, because from our perspective, we believe that across the brands themselves, Gucci, Saint Laurent, Bottega Veneta, there has been a disconnect between how the creative director and the CEO, who ultimately have the most power, pushing out these different clothing brands throughout, or clothing lines, excuse me, throughout the year, in relation to what the customers are actually wanting, and how the customer base is shifting in that regard. So we see a heavy risk in that, and especially given Kering's concentration with Gucci, we believe that if Kering doesn't shift now, then they could be in for troubled waters.
Just a quick follow-up on that, because the company looks quite cheap at the moment, especially on a PE basis, maybe not the other multiples. But as you said, it's a decision based on the business analysis. Aren't they doing the right things in the short term? So more pain in the next, say, 1, 2, 3 years, but the right things for the long term. And if so, what would make you change your conclusions? I think you said something like, we prefer to be prudent at the moment and stay on the sideline. What would make you change that?
Samir, would you be able to go to the timeline, please? Yeah, for sure. So as you alluded to, we believe that the long-term perspective that Kering has taken is a very good one. So they decreased their CapEx, or their dividend payout, and then they increased their CapEx. So they're taking all the necessary steps in order to set themselves up for the long term, which we acknowledge and we have integrated into our analysis, as you can see. We believe that the long-term benefits, enhanced pricing, acquisition benefits, and profit diversification are all there. We believe that Kering can achieve it. In the short and medium term, however, we believe that, especially as we said in regards to the creative director and the CEO, we believe that maybe the choice of denim for Gucci may have not been the best decision in that regard, given that, as you can see from the recent stock decrease, I believe it was about 20%. The market is reacting badly to it. So there's some sentiment that maybe he is not up for the job. And we kind of share that sentiment in that regard. So we believe that they are taking the long-term steps, but we believe that they have some things to figure out in the short term before we can embolden our whole position to a buy, given the discounted price.
Thanks.
If I could add something really quick onto that. We believe that this increasing CapEx and just brand strategy and brand revitalization in the luxury sector typically spans across multiple product cycles, and the risk here for Kering lies in just execution, because if CapEx fails to translate into a tangible brand uplift or market share gains, the return on investment could be muted, and that's why we decided to be careful.
Okay, regarding the underlying structure of the company, I would like to hear from you what is your idea in terms of strategy and in terms of reorganization, looking at the core aspect of this fashion organization, which is the designing and the customer loyalty towards the story of the Gucci Group. For instance, would it be a good idea to accelerate Valentino acquisition, full acquisition, or would it be better to streamline lines, focus on the historical ones which had performed very well in the last 20 years, and starting from there to relaunch the full group with a very well organized and distributed brands and product lines.
I'd be happy to touch on this one. If we could please go to just appendix H6 really quick. We believe the company, it's getting back to its roots. They started selling their real estate investments, and we believe they're going to start investing more into buying brands and integrating brands within the company. And we believe that definitely taking a step back on the big real estate investments that they made in the past years and moving towards acquiring brands, it's the next logical step for Caring, not as of right now, considering current capital structure. But we believe that in the long term, integrating Valentino and just investing more on the main brands could be the strategy that Caring would go for.
Maybe if I can add to that as well. So what we have seen in the past year is that those brands that basically returned to their historic origin have performed the best in the market conditions as of last year. So Caring is addressing that issue as well, stating multiple times that that's what they're trying to do as well with Gucci. However, as we have seen, particularly with the new announcement of the creative director, we believe they actually took a step back from that. So that has to be one of their main focus points going forward. And then in terms of accelerating the timeline on Valentino, according to our projections, we see that 2028 would be the first or the point at which they would be healthiest to go forward with this step.
Hi, this is Asad.
Thank you.
I have a question on the valuation. If you go to the valuation summary, you have used, I think, 80-20 on your DCF and relative valuation. So the first question is, what is the thought process behind using these percentages, 80-20? And then on the DCF, you are using a 40% terminal growth. Again, so what is the thought process behind the 40%?
Yeah, for sure. So I can kind of walk you through the process. So originally we did a equilateral split. So we did 30 for the terminal growth for DCF, and then 30 for the exit multiple, and then 30 for the comps. However, as we noticed, using the comps detail with the 8 competitors in the industry, we saw that in general, the luxury sector has historically had significant dispersion in trading multiples in relation to other industries, which are pretty much always inflated. And given that even before the current tumultuous nature that's going through the industry right now with the tariffs and so on and so forth that we can touch on a little bit later, we felt that Caring was overpriced in terms of a relative comps. So that's kind of why we scaled it back in that regard, at least for the comps part. And we split it equally between the exit multiple and terminal growth because as I stated previously, we had a little bit more control over how the future cash flows were moving, additionally monitoring the debt levels, because Caring, in addition to just downgrading in their credit, they also increased their, I believe they added on about $100 or $500 million of debt at the end of 2024 last year. So we wanted to monitor that closely, and then additionally include all the others like the synergies with Valentino. So we had a little bit more control of that, which kind of is why we equally weighted them, because we still wanted to see, we didn't totally want to dismiss the increased multiple nature of these luxury industry, because that is built into the industry itself. But we still wanted to provide some sort of tangibility to the discounted cash flow and the valuation as a whole.
So one follow-up question on the same discussion on the valuation.
Sure.
Because this is a kind of a business where a lot of goodwill involved, or a kind of a net intangible value is involved. Have you done any analysis and compared that? What is the impact of intangible value in your valuation?
Samir, would you be able to go to the forecasted balance sheet, please? So in regards to an exact analysis of it should be, yep, you got it. Yeah. Or we can do the assets, please. Yeah, perfect. So in regards to an exact analysis of the intangibles, no, but we were able to, when we constructed this free cash flow to equity, we were able to monitor them as they went. And as you can kind of see from 2028 is when we forecasted Valentino to come along. You can kind of see how the intangibles, given the amortization and depreciation, have kind of stayed the same over the subsequent years, and they decreased a little bit due to the expenses involved. So we haven't, in terms of like spinoffs or anything like that, we didn't really do an analysis, but we felt that given that Francois Pinault is the majority shareholder at 42%, and his kind of mantra is not to divest any of these luxury brands that he has built since the 1960s, or his father has built from the 1960s.
Okay, thank you.
In your opinion, are Kering brands capturing younger, high-growth consumer segments like Gen Z and millennials? And how are they adapting to changing luxury consumer behavior in terms of sustainability, second-hand markets, etc.?
So hi, I would be happy to take that question. So recently we've seen that Generation Z has overall decreased their spending on the personal luxury goods because they do not see value for their purchases. They have shifted from the soft luxury products more towards the eyewear and beauty segment because they feel like those have more they have more value in those with those purchases. So as we have seen, Kering is growing their eyewear and beauty segment. So we believe that through those brands that they are well positioned to capture the younger generations through those brands. Alternative, like the second question that you said about the secondhand. So secondhand has also increased quite a lot within the younger generations. They're purchasing more. Something that Kering is increasingly looking at is the secondhand market, and as well, they have some connections with the Vestiaire collective, which do secondhand sales. So we believe that with the eyewear and beauty and with their connection with the Vestiaire collective, that they are moving forward and taking the necessary steps to capture the younger generations.
If there are no further questions, we can end the Q&A. Have about 25 seconds left. So thank you, International University of Monaco. At this time, the judges will take a few moments before the next university is brought in.
Thank you. Thank you. Appreciate your time.
Thank you.
Thank you.
Hello.
Hello. Welcome, Kozminski University. Please launch your presentation and make sure everything is working properly.
Dear investors, hello and good afternoon from Poland. We are excited to be here today presenting you our equity research on Dom Development, Poland's leading residential real estate developer. Did you know that the average per square meter prices have doubled in the last 6 years here? As a market leader, Dom Development is cashing in on this boom. Yet we believe the stock still undervalues the company's full potential. And that is why we are issuing a buy recommendation on the stock with a 12-month target price of 271 Polish zlotys. This implies a 26% upside from the close of 1st April. Founded in 1996, Dom Development specializes in multifamily housing. It has delivered over 53,000 units to date and impressively has not missed a dividend in 18 years. Operating in Poland's 4 largest housing agglomerations, Dom Development posted 3 billion Polish zlotys in revenue and has delivered 4,000 units last year, making it the de facto leader on the Polish market. Dear investors, we see 3 reasons why this is a compelling investment. First, it is well positioned to sustain its market leadership. Second, Dom benefits from a structural housing gap in Poland. And third, it has a robust pipeline of land bank with an affluent client base. Our conviction is further strengthened by 13 industry expert interviews we have conducted. And now, I invite you to take a look at the business model.
Dome development follows an integrated business model, acquiring land strategically, securing permits, and managing construction through in-house contractors and external subcontractors. Sales begin during construction, complemented by value-added services like mortgage consulting and turnkey apartments. Additionally, the company acquires land fast, creating a robust inventory that is capable of supporting a 5-year project pipeline. Moreover, its focus on the premium segment targets a more affluent, cash-rich client base, enabling the company to pass rising costs onto its customers. This supports Dome's sustained margins and profitability, reinforcing its competitiveness.
Think about this. Poland is facing a structural housing gap. Simultaneously, home ownership isn't a financial decision. It's part of culture here, shaped by the country's history. And yet, Poland has one of the highest overcrowding ratios in Europe. This is where Dome development stands. Adding to that, Dome's key cities continue to grow, defying the national trends. The influx of 2 million Ukrainian migrants due to the ongoing war has further accelerated the urban migration. And our analysis indicates that many of them will remain in Poland for the long term. The result of this, a housing market with sustained long-term urban demand. But demand alone wouldn't be enough. Affordability is the key. With inflation falling, interest rate cuts in late 2025 will unlock purchasing power and boost demand further in medium term. On the other hand, our analysis, backed by interviews with industry experts, including CEO of Dome's direct competitor, highlight rising costs will squeeze margins, including those of Dome development. In the meantime, short-term sentiments remain mixed. While new offers from developers are increasing, slower demand in 2024 has pushed the inventory to a 5-year high across Poland's 6th biggest market. Yet, rising construction permits signal renewed confidence for the future. So how does Dome development thrive in this environment? The answer lies in its strategic land bank. What truly sets it apart is the quality and prime location of its asset. The premium portfolio secures a distinct competitive edge, reinforcing our first and third investment thesis. But wait, strong positioning means nothing without execution. Even in a challenging 2024, Dome development outpaced competitors in both speed and volume. As weaker players struggle and market consolidates, Dome is set to capitalize on these opportunities backed by its strong balance sheet and high cash reserve. Now let's see how all this falls into our financials.
Dome development continues to deliver consistent revenue growth supported by healthy margins. To forecast this trend, we analyzed historical projects dating back to 2012 and extrapolated a construction pipeline adjusting for pricing dynamics across cities. Profitability is expected to soften gradually due to rising construction and labor costs, but margins are still projected to remain at healthy double-digit levels. Nonetheless, strong fundamentals remain intact. Structural demand drivers like urban overcrowding, rise migration, and improving financing conditions support ongoing sales momentum. These trends allow Dome to partially absorb cost pressures and maintain a stable growth path even in a changing macroeconomic environment. This resilient performance is underpinned by Dome's disciplined financial management. The company's low net debt levels and stable cash reserves protect against volatility, giving it a reliable foundation for operations. Its conservative approach not only reduces financing risk, but also enables strategic flexibility, allowing Dome to pursue growth without compromising stability. Additionally, the company presents strong value creation for shareholders. Its consistent dividend policy and top-tier ROE reflect prudent capital allocation and long-term vision. By balancing profitability with a commitment to reward investors, the company has built a track record of delivering attractive and predictable returns for income-focused investors. At the core of this financial strength is Dome's unmatched operational efficiency. Its market-leading cash conversion cycle allows quicker project turnover, lower financing needs, and faster reinvestment. In an industry where execution matters, this agility strengthens Dome's ability to grow sustainably, seizing opportunities as they arise while minimizing risk.
This is shown perfectly in Dome's growing alignment between sustainability and strategy. On the environmental side, Dome has doubled its renewable energy use in just 1 year and is actively reducing emissions. These actions support the company targets and contribute to its better ESG risk score. Socially, Dome designs accessible, livable neighborhoods through its 15-minute city model. Internally, it leads the sector in the employee retention and has above-average gender diversity at senior levels. Governance. is also evolving. The appointment of an ex-chief ESG officer as the new CEO and the company's first female CFO signal that ESG priorities are starting to influence leadership at the highest level. That said, there are still gaps. CSRD alignment is in progress, ESG-linked KPIs haven't been disclosed, and DOM has yet to adopt green building certifications. So overall, the ESG impact is mixed, but one area stands out: it's people. We reflect this in our valuation by lowering the growth of payroll costs linked to high retention and applying a lower WACC only in our bullish scenario, recognizing these two factors as the current long-term value drivers for the company.
We valued DOM using a 50-50 blended approach of DCF and relative valuation, allowing us to capture both the company's long-term intrinsic value and market perspective. Key factors considered in DCF model include DOM historical project trends, current land bank capacity, and a detailed pipeline projection. We applied a stable WACC of 9.4%, where our cost of equity includes a 40 basis points premium for DOM's low trading volume, while a cost of debt is yield to maturity of DOM's bonds. We determined a terminal growth rate of 2.6% using key value driver formula. Even with our conservative revenue estimates and a cautious margins assumptions, our DCF analysis shows a 28% upside, leading to a valuation of 275 PLN per share. To stress test our valuation, we conducted a sensitivity and a bull and bear case analysis by varying key assumptions. In our bull case, we also assume the issuance of green bonds, leading to a 10 basis points reduction in cost of debt in line with EPRA research on developers. The scenario analysis indicates a potential upside of 36% and a downside risk of 12%.
This is not it. We also used EV to EBITDA and price to earnings multiples for our valuation. We built two peer sets, Polish peers and European peers based on similar business models, and then filtered them using the GPR framework. However, for the final valuation, we only used the Polish companies because of specific market conditions in Poland. Dear investors, DOM Development is trading at an unjustified discount, and we see there is a strong re-rating opportunity. The price to earnings ratio gives the price target of 260 PLN, a 21% upside, whereas the median next 12-month EV to EBITDA of 9.1 times gives us a price target of 27%. In our sum of the parts model, we have extrapolated a pipeline of deliveries for the next 3 years, and this is embedded into our revenue forecast. This method also gives us an upside, supporting our other valuation methods of 24%.
Despite our strong recommendation, we have identified 3 key risks. First, inflation and a sustained trend of high interest rates may weaken residential sales and squeeze developers' margins. Second, uncertainty around mortgage program poses an additional government risk. Third, the Ukraine war threatens migration, capital, and labor flows. Dear investors, in Polish, DOM means home, but to us, DOM stands for dominance, opportunity, and momentum, the core drivers of our buy recommendation. Now, from Poland to the world, we open the floor for any questions. Thank you.
Thank you. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Hello, thank you for the presentation. What makes you think there will be an interest rate cut in 2025, and what will be the level for such cuts in your opinion? And how do you assess the impact of such cut on Polish residential market?
Thank you for the question. My name is Aniket, and I would be happy to take this question. So our forecast about interest rate cut is based on 2 different aspects. First, the 12-15 FRA indicate that the interest rate would be falling by 101 basis point. Second is based on the comments by the head of National Bank of Poland, Adam Glipenski, who was of the opinion that interest rate cut could come in as soon as May if the inflation remained under control. And for the next year forecast, the NBP projects a benchmark rate of 3.5 to 4%, depending on the inflation. And coming to the point about how it would impact our valuation, we see that DOM Development majoritarily sells apartments on cash. Nonetheless, lower interest rate would unlock purchasing power for the customers who are looking into mortgages. And the CEO of the company also was of the opinion that lower interest rate would mean that they would also be introducing new apartments in the popular segment.
Hi, this is Asad. Can you go to the valuation summary sheet? And I have a couple of questions there.
Yes, indeed.
You have used a 80-20 combination for DCF and multiple valuation. So what is the thought process? Why 50%, 50-50? Generally, like it's a development business, maybe a lot of cash flows are involved. But what is the thought process for the 50-50?
Sure, I will tell you why we used a 50-50. Yeah. So we avoided equal weights. So we have 6 valuation methods, but we only weighed 3 of them. Now we wanted to show our analysis that DCF is the true intrinsic value of the company. So that is why we use 50% for DCF. However, we saw that there is a strong re-rating opportunity on the markets, and DOM is not trading at the medians. So we thought, why not use this? But here the reason is also that we did not want to over rely on our assumptions in DCF, because of course DCF is driven by our assumptions, and as analysts we are positive. But we wanted to also look at what the market is saying, and that is why we decided to take the most common multiples of price to earnings and EV to EBITDA. So while this is a real estate business, our valuation was driven by these 2 thought processes, why we weighed them like this.
And what is the terminal growth for the DCF?
So the terminal growth rate for the DCF is 2.6%, and we calculated it based on the key value driver formula by multiplying our RONIC and reinvestment rate.
And one more question on valuation is: have you taken the impact of ESG scores on your valuation? I saw something, I don't remember if there is any specific impact it's taken.
Yes,
I think it was on the ESG sheet. Yeah, I think the payroll expenses are reduced or something. What is that?
Indeed. Once again, I'm Shahir. Here, we looked at this research paper called the cost of employee turnover. And here, we know that DOM's employees have been retained for 5+ years, average retention, whereas others are like less than 5 years, even less than 3 years. So DOM boasts a strong and healthy retention ratio in the market. And if your employees are staying with you for longer, then of course the economic value the employees are adding will exceed the costs invested into the employees, whether it is attrition or rehiring or training. So due to this fact, we decided that DOM definitely deserved this, which is also supported by the cost of employee turnover research paper. So what we do is we just reduce a little bit of the growth rate of these payroll costs, but we don't say that these are not going to grow or going to fall down, but we keep increasing them. But because of these factors, we just reduce the growth rate.
That is the social part. For the environment or climate part, is there any impact of the climate on the real estate development or whatever development they will be involved?
Thank you for the question. My name is Anastasia, and I'm happy to take it. So because DOM has been, Shahir, if you could go to the slide on ESG strategy, please. So because DOM has been actively including their ESG strategy since 2021, we can already see that their costs of changing things connected to the environmental and governance aspects have already been incorporated in their historical costs. So we just use the historical data for that.
Okay, thank you.
Thank you.
I have a question on the market that fits into your valuation. If home ownership is so high in Poland, who are going to be the buyers in the future? Is there any immigration changes in demographics? And related to valuation, I see you are using enterprise value to EBITDA as your main metric. Why, if DOM development is the best and the biggest in Poland, it trades at a lower value, at a lower multiple than the others, and also the European peers trade on actually half that value? So how confident are you that the multiple for DOM development will increase rather than decrease in the future, which is also linked to the fact that you expect still healthy margins, but declining margins. If margins decline, the multiple assigned by the market is likely to go down, not up.
So my name is Anastasia again, and I'm really happy to answer this question, and then it will be followed up by my colleague Shahir. So first of all, on the demand, we've identified there's a structural housing gap in Poland, and that's backed by our research, that's backed by reports from JLL and McKinsey. So the structural housing gap is essentially based on three factors: quality, spatial, and quantity. In Poland, the research has identified that there's not enough housing for the people. The people who live in their current housing units do not have enough space, and the quality of housing is quite low because it's quite old. So therefore, we can see that there will be growing demand as people want to lift themselves from this economic situation with the increasing wages. Now my colleague Shahir will take over.
Thanks, Anastasia. Quickly to add on your part, yeah, because Matteo, you also mentioned a bit on the migration and the demographics, because Poland, and just like Europe, is suffering with the demographics. But here, as you see on the right side of the chart, DOM operates in 4 cities, and these 4 cities are like the biggest urban metropolitan cities in Poland. And here, while the overall demography is going to decline because total fertility rate is declining and a lot of other factors, but these 4 cities where Tom operates is going to still have the effect of urbanization, which is going to increase. Now, coming to your question about why are we undervalued, I would like to show you the slide on, of course, European peers. In our analysis, we actually found that European peers were trading at a bigger multiple, which were really comparable to DOM development in real estate. So we took some examples from different European countries. However, the question on margins are decreasing, but why do we think there will be a re-rating of the stock? We think that currently the market is actually swapping long-term structural tailwinds with the short-term uncertainties, and that's why we do think that DOM is not trading at the level, given it's the market leader. Others are suffering, but DOM is really at all-time highs and still growing their sales. It's still not trading at the level it needs to, so there is definitely a strong re-rating opportunity here.
Okay, thanks. I might have other questions later.
Has there been any legislative and regulatory changes recently impacting the housing market in Poland? And are there any new ones in sight?
Hello, so my name is Sofia, and I will be happy to answer this question. So, in fact, yes, there is legislative changes in Poland right now going on. The latest one is basically about the zoning regulations, and it in fact impacts the most developers in Poland. So the change will be basically having an impact which will decrease the land supply for the developers. It will also increase the property prices, and there is in fact the risk of the construction slowdown within the developers. So we also took it into account, and we conducted a sensitivity analysis, and we took into account that our valuation might be decreased due to this fact.
What about slide number 10? Can you walk us through the thinking that you made to compensate a positive financial interest outlook against operating factors, which looks from very, very difficult to almost very difficult, such as price of energy, cost of labor, etc. And how do you factor all of this into your model?
Thank you for the question. I would like to take it up. So for the interest rate, we see that it would be positive for the market in medium term, as we said, because it would increase the availability and affordability of mortgages. Now, coming to the rising cost, we do believe that these costs would contribute to a falling margins, and these margins would fall to the historical averages that were experienced in the top 6 cities. That is 27 to 28% of margins. And we believe DOM would be slightly higher than the historical averages, given that they operate in the premium segment. Thank you.
So, according to what you said, the 9.9% average grade growth is confirmed. The revenue average compounded average growth rate is based on what you said.
Yes, right.
Okay.
How much of your conclusions are based on average prices per square meter staying high? Because, correct me if I got it wrong, but you said that a lot of Poles like to own their homes, and they are looking to move from old small houses into bigger ones. But to do that, they have to sell their old small at a good price to afford a new house, considering that average prices have doubled over the past. So how much of your final conclusions are based on prices will stay up a lot?
Sure. Actually, the base of our revenue assumption is actually coming from per unit transaction prices. Yeah, and this is actually quite conservative because as we saw in the start that just in 6 years the prices have doubled per square meter. But we are assuming that the prices will grow, but at a much slower pace, which is 6% CAGR over the next 6 years. So we have dramatically reduced this growth rate. This is a very interesting point, Matteo, because really Poles are currently living in sometimes in flats that need to be sold to really move to a new flat because the standard of living is increasing. We actually had this slide where we wanted to discuss the key statistics in Poland, where the GDP is increasing, the overall salaries of Poles are increasing, and more corporations are coming here. The economy is benefiting. So the aspirations have increased. So people will sell their apartments and move to new ones. However, there are some mortgage subsidies coming in as well, which also support these sort of programs for Poles and their aspirations.
Okay, if I may, I have another quick question. I don't know how much time we have. Can you please comment very quickly on capital allocation going forward? How much you expect it will be generated in free cash flows, and how much will be allocated to CapEx, dividend, share buybacks, repayment of debt? Probably not, because they are already low. Anything on that?
Absolutely. My name is Oscar, and let me tackle this question. So as for the capital structure, we assume that the capital structure going forward is going to be very similar to what is now, as the company is going to pay out a similar rate of dividends that they are paying right now, and we do not expect any additional share buybacks or the additional equity allocation, due to the fact that currently the company free float is already low, and the company is not able to decrease the amount of shares available on the market without compromising the price.
Why was dividend decreased last year?
Of course, I would like to. It's actually on the bottom right call-out box, yes? So what happened was Dom was paying out dividends for the current year based on the profit from the previous year, yes? And what happened in 2023 is that the board decided to please their investors and give them an advance dividend from the current year's profit as well. So what they did was basically take the net profit from the previous year and give the dividend, and then give an advance dividend from 2023 as well. So you see the spike on the chart. And then, of course, this was the first time the company ever did it, so there was a spike. And then now the company, we think, in 2024 also announced the advanced dividend. So this is going to continue, and that's why you see a drop. But I don't think it's any concern, to be very frank.
Okay, no, sorry, I got the chart wrong. So my fault. No, okay.
That is time. Thank you, Kozminski University. At this time, the judges will take a few moments before the next university is brought in.
Thank you so much.
Thank you.
Thank you.
Such as charging infrastructure and high upfront cost. Without these measures, our projections show that EV sales could present just 23% of the overall vehicle sales by 2030. And not only EV has to face these new macro challenges, but its own ambitious targets. To achieve management plan of having 10% of the EV US market share by 2030, EV has to execute mass production with still prevailing manufacturing problems and navigate a new consumer base. And all this has to happen through the most contested area representing small and mid-size SUV segment, with continuous influx of new models. This strategy even more exposes Rivian weaknesses, which is now facing new complexities of entering the mass market.
Even though Rivian has no room for a mistake due to large cash burn, where over the past 2 years, they burn approximately 1 billion per quarter. If this trend continues, Rivian will run out of cash within 6 quarters, facing serious concern about their operations. In order to solve this issue, the management has introduced the consumer expansion with the R2 and R3 vehicles. For this to happen, Rivian's revenue mix will need to transform. Mainly, the demand for R1 is expected to decline with increase in EDVs, leading to a drop in average selling prices for these vehicles. In contrast, R2 and R3 are expected to drive revenue growth with ASP of $50,000 and $47,000 respectively. However, focusing on high-volume vehicles means that Rivian's profitability will depend on achieving scale efficiently, which does not come without costs. Total fixed and variable costs will increase as production scales up, even though the company will reach optimal industry factory utilization of 70%, thus reducing the fixed cost per unit. Furthermore, R&D expenses are expected to rise due to industry's competitive nature, putting further pressure on Rivian's profitability and its margins. And as we look at Rivian's key financial metrics, we can see they point to a critical issue. A continuous cash burn of $2.2 billion puts the company in need for external financing. However, at this stage, no bank or equity markets are willing to provide it, which makes the company dependent on their partners. While the Volkswagen deal did provide short-term liquidity, it also came at a cost of a 10% share dilution, further eroding shareholder value.
Building electric vehicles that help in CO2 reductions is just not enough. Rivian ranks 72nd out of 88 companies in ESG risk with limited transparency in reporting. Despite pledging to become net zero by 2040, the company lacks clear reduction targets, questioning its climate strategy. On the social side, Rivian has the highest number of serious labor violations, far exceeding its competitors. It creates legal and reputational liabilities which could weigh on investor confidence, putting social efforts aside. Governance adds another layer of risk as only 1/4 of management targets have been met, and RJ is holding all of the key positions in Class B shares. Executive compensation with 95% in variable pay adds to risk even more, as targets are not clearly tied to profitability or creating shareholder value, while most of the equity awards are out of money, limiting their motivational effect. On valuation, we relied entirely on income approach. Rivian is an early-stage company which has yet to reach operational maturity. Its valuation is primarily driven by future cash flows coming from future projects, R2 and R3. Our 10-year DCF model relies on R2 and R3 as key revenue drivers, while factory utilization and lower variable cost per unit enable margin expansion. However, increasing R&D, SG&A, and CapEx for new factory will pressure near-term cash flows. Our WACC declines from 11.4% to 10.6% in terminal period, determined by lower cost of equity and debt and introduction of tax rate as Rivian becomes profitable. Our DCF model implies target price of $9.93, representing 21.7% downside on the closing price of the valuation day. Relative valuation was rejected due to no adequate peers, even after grouping the analyzed companies in comparable sets based on their growth business models and geographies. These companies are in different growth phases, operate in different regulatory environments, and have small or no financial comparability with Rivian.
We conducted Monte Carlo simulation, where we stressed key inputs such as R2 deliveries, average selling prices, WACC, and terminal growth rate, and we came to the conclusion that 63% of outcomes support our sell recommendation. We also recognize 5 key upside risks, which are represented on the risk matrix. However, the 2 key risks for our recommendation are that the R2 deliveries will exceed demand expectations, in which case our recommendation will change to hold. Also, Amazon and Volkswagen could provide additional funding, which will reduce the risk of the company, but our recommendation will still remain in the sell region. And finally, as investors face significant risk of bankruptcy, dilution, and only a capital gain as a possible return, which is one of the key reasons why we issue a sell recommendation. Thank you for your time and attention. We are open for your questions.
Thank you. Judges, you may now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
So, thank you for the presentation. If you as a team were elected as the management of this company, what will be the first 3 things you will do to change the way that you expect Rivian is heading to? And my second question is, will Rivian be a target for other EV producers if the situation worsens?
We recognize 2 key changes that Rivian still can make. First is their transition to the dealership model, and second is their workforce treatment. Firstly, D2C sales model was initially a good idea because of the two reasons. It makes a tighter connection with consumers and it lowers the sales cost. As well, using B2C sales model, distribution costs make up 15 to 20% of the overall vehicle price. However, this strategy didn't materialize, as Dealership Association is one of the strongest networks in the US, and still 70% of the vehicles are sold through the dealers. Additionally, we can see on the graph on the right that some states directly restrict the use of D2C sales model. And the second is their workforce treatment. So Rivian had the highest number of the serious safety violations, which despite having only one plant, which caused serious injuries to their workers needing for surgery. And this is even more concerning as serious violations belong to the group of the unsafe conditions management knew about but did nothing to fix them. And this situation, coupled with 10% job cut, directly impacts Rivian's capability to keep the workforce. However, as employees stated that this was the reason because they didn't have proper safety training and adequate equipment, we would firstly change that in order to not be this kind of workforce overload that happened to Rivian.
I would like to ask a articulated question about slide 25 and slide 12. Basically, on slide 25, we have the average selling price, I assume expected average selling price for the R2 and the R3, which should be the cars responsible to a recovery in the performance of the organization. The cars of the Rivian company are quite good looking. I cannot articulate about the technology, but the aesthetics is very good. And also the picture of the manufacturing site is at the same level of the main manufacturers. So I think that there are a few key aspects to be fine-tuned in order that this organization could return to efficiency and effectiveness. And the response is in page 66, where we have an articulated multi-brand product portfolio, where stands out to me Chevrolet Bolt for 27,500, Kia for 30,000, and Tesla Q model 25,000, whereas Rivian proposed two cars at the price that put them already out of the market, as far as I'm concerned. Would you be able to elaborate a little bit more, taking also advantage from the previous questions about what would be your first action if you would be the CEO of the company, with the specific focus on this product portfolio aspects? Thank you.
Yeah, okay. So while it is true that Rivian's current price of R2 and R3 puts them out of the competition that we have stated here, they would, if we were the CEOs, we would want to attract the consumers who were originally buying Rivians, such as R1 vehicles, which were in the, let's say, luxury or more premium segment. However, this is highly unlikely, as Rivian cannot hedge against raw materials and inflation and tariffs that are going on, which is one of the reasons why we started with a higher price. So for example, just the 25% tariffs on aluminum would result in increase of variable costs for these cars, and they would need to keep the average selling prices high. So if I was the CEO, I would try to better hedge against these raw material price increases.
And make an example. For instance, the Suzuki SUV Ignis is a very small SUV, and it can be sold at a very interesting price, and actually is the car through which Suzuki manufactured saved somehow their performance. So would you think resizing the model of the future entry in 2026 or 2027, or even think about a nice ICE vehicle, switch, as everybody's doing now, switch to the engine with gasoline or gas?
Yeah, so I can take the question. Why Rivian is actually entering in the SUVs is because the SUVs currently represent more than 50% of the total vehicle sales in the US. And therefore, many other manufacturers who are trying to, let's say, stay in the EV market are actually trying to do so with the SUVs because those are the most popular models in the US, even though this is the most contested area. So Rivian's strategy in the first place was also accounting this, as they entered with the first R1T truck, but however, as American trucks are often associated with high powers, their sale was not as expected. So actually, why Rivian is entering with the SUVs is because it has the most chance in reaching scale by this segment.
And I want to add in regarding the question for the ICE vehicles. Of course, we would consider that because it is still 80% of the vehicles on the road in the US are ICE vehicles. However, we didn't mention this because we wanted to assume some things that Rivian still can change. And this is highly unlikely because the CEO has the all power in his hands. He holds all Class B shares and all the votes. And he owned the company in 2009 with the vision of clearly making only EV vehicles. And we can see that as he still isn't transitioning to the ICE vehicles, and he still loses the shareholder value, he still loses the liquidity of the company, but he still doesn't think of it. So if we could change from the start something, we would for sure do that, because this isn't the time when it is only to be pure EV automaker is the hardest.
Okay, thank you very good. Thank you very much.
Hi, this is Asad. Can we go to the valuation summary slide? I have a couple of questions there. So you have used basically, I think the previous one, you have used the DCF only because of the certain issues you have highlighted for this company. So the first question would be on the DCF model is that you think that the company can still survive, and then you're still using a going concern assumption for this company, correct?
Yes.
So basically, that the company will survive, and then you're using a going concern assumption. But have you also taken a view in case if it doesn't survive? So what would be the liquidation value, or what kind of the worst case scenario for in terms of valuation?
We constructed our bull and bear case scenario, where we can focus here on our bear case. Since we understand that this industry is highly politicized and they obtain a certain amount of cash, amount of money, we believe that it is unlikely that it will go bankrupt, but it surely is a possibility. However, in our gray sky scenario, we project that deliveries will be, let's say, 5% lower, mainly because of the lower demand for EV vehicles, the politicization, and the less amount of funds that are given for the EVs. Additionally, the average selling prices will increase, as well as the R&D as well as the increase in R&D expenses and a lower terminal rate. So in our bear case scenario, we will result with a share price of $1.85 and a negative upside of negative 85.4%.
And also, I would just like to, I'm sorry. I would just like to add that we projected that the company will not go bankrupt and it will be going concern, right? Due to the fact that its cash influx from Volkswagen gives it some kind of safety margin, and that it will therefore survive, and also the loan that they got from the government on the last day of Biden's administration. So there are reasons that they will, let's say, survive, but the question is how much market share they can get and to which levels they can scale their production.
And because if one of the slides you were showing a potential revenue growth of I think 17-18% CAGR, so in that case the company will have a kind of a decent revenue growth, but the issue will always be on the margin side to survive.
Yes, as we mentioned in our presentation, while it is obvious that margins will increase as Rivian gets the scale and increases factory utilization, this will still require significant cash outflows, because, as we mentioned in our presentation, with the rise of deliveries, we will have three major costs. First is the variable cost will increase as production scales up. Second is that selling expenses will also increase, mainly because of the Rivian's D2C model, which will require significant marketing, significant logistics to deliver the vehicle directly to consumers. And thirdly, because of the R&D expenses, which are a major thing in this industry, and the industry standard for this vehicle is to come out new vehicles to come out every 2 to 3 years. So all of this combined will pressure the margins for Rivian, and they will still be in a position where they would require external financing to basically survive after that certain period.
Last question would be on ESG. Have you taken the impact of ESG in the valuation calculations?
Yes, we included ESG factors into our assumptions, and therefore there can be seen through our cash flows. So first, regarding the environmental aspect, we included green revenues that Rivian actually has the ability to sell, as it is producing zero emission vehicles. However, we project in the future period that the regulatory credits per vehicle will decline due to the government shift, the shift in administration, moving away from a green agenda. Also, we, as Rivian has green bonds, we analyze the possibility of the cost of debt that the company in terminal period will be lower due to this fact. But unfortunately, Rivian does not set clear reduction targets and has some serious ESG risks, so we did not include it. On the social side, we included the fact that Rivian has the highest number of serious labor violations compared to the others, and also the announced unionizations. So in our model, it is assumed that the company will not be able to lower COGS and OPEX related to labor costs much effectively. And in the end, on the governance side, as management has missed targets in 75%, we did not rely on their forward-looking statements, but rather our own analysis, and also the interviews with industry experts, which we conducted in order to get a clearer picture. And in the end, I would just like to add that we did not apply the ESG premium because we derived the beta directly from regression, so it wouldn't be suitable in our case.
Thank you.
As it's the topic of the month, any discussion on the impact of tariffs on China, EU? Basically, how much of the Rivian production is done in the US, so not subject to tariffs?
Yeah, as you mentioned, Rivians are not directly subjected to these tariffs imposed by the Trump administration on the foreign vehicles, since it's producing 100 of its vehicles inside in the US. However, we will see an indirect impact of these tariffs as the demand for domestic raw materials.
Thank you. Thank you, University of Belgrade. At this time, the judges will take a few moments to collect their thoughts before the next team is brought in. Thank you so much. Welcome, University of Neuchatel. Please launch your presentation and make sure everything is working properly.
Hello, can you hear me?
Yes. We
Hello,
ask
can
that
you hear us?
you, oh, yes. We ask that you remain muted unless you are speaking. Time will begin as soon as a member of your team speaks the first word. You will receive a 1-minute warning and time will end precisely at 10 minutes. Feel free to begin.
Is your portfolio ready for the energy transition? Meet Burkhardt Compression, Switzerland engineering champion in the race to clean energy. We are from the University of Neuchatel, and here's why this stock belongs in your portfolio. Based on the three drivers. First, Burkhardt is well positioned to capture market growth. Second, mix shift improve EBIT margin. And third, technical edge unlocks higher revenues and margins. We issue a buy recommendation with a target price of 622 Swiss francs and an upside of 22%. Compressors are indispensable for the energy infrastructure. Burkhardt Compression, one of the world's largest producers of reciprocating compressors, supply the technologies that enable the processing, storage, and distribution of energy for critical supply chains such as oil and solar. Operating through two divisions, system and service, its revenue is driven by the gas and petrochemical sectors, with China and Europe as leading markets.
For the industry, Burkhardt stands out as the market leader in reciprocating compressors with a 16% global market share. The company differentiates itself through specialization and a singular focus on reciprocating compressors, which gives them a competitive advantage with a strong presence in both traditional and transitional markets.
Our first driver highlights Burkhardt's unique position to capitalize on the energy transition driven by its superior products. The solar is one of the fastest growing energy markets, where Burkhardt captures revenue supplying hypercompressors. These are essential to the production of EVA, a key component in solar panels. In a niche with only one competitor, the company's expertise ensures unmatched performance, making it the go-to provider of compressors. Burkhardt captures revenue from the growing LNG market, supplying compressors for gas transport and storage. Global developments are accelerating investment in LNG vessels and terminals, crucial infrastructure where Burkhardt truly excels. With superior durability and efficiency, its unique products position the company to capitalize on this opportunity. Hydrogen is expected to contribute 17% of systems revenue by 2029 as global infrastructure builds out. Compressors are required at every stage of the value chain, from production to end use. Ability to serve them all opens up broad revenue opportunities, as Burkhardt offers the most complete solutions on the market. While hydrogen offers significant potential, we maintain a cautious outlook given its early stage. Burkhardt's superior technology positions it to capture revenue across solar, LNG, and hydrogen. But what the market truly underestimates is the resilience behind that technology. No matter how the energy mix evolves, its compressors remain essential. This ability to generate revenue across all scenarios is what makes Burkhardt not just a transition player, but a growth story the market has yet to fully price in.
Supporting the system division, Burkhardt's unmatched cross-brand compatibility position it as the service leader in the growing oven and other brand compressor markets, which increasingly require revamps, retrofits, and replacements. As a result, we project a rising service share in non-Burkhardt compressors, and by 2029, Burkhardt is expected to capture 34% of service in Asia Pacific, 26% in Europe, and 13% in North America. Burkhardt also locks customers into a unique service ecosystem built on three key pillars: a razor plane model that pairs compressor sale with 5 to 10-year maintenance contracts, a service system embedding proprietary technologies in 80% of service, and a safe reinforcing service loop
enabled by digitalization. This strategic model is extremely costly to replicate or switch, and therefore securing strong customer loyalty. But why do customers choose Bookat? Across key metrics like predictive maintenance accuracy, it shows consistent outperformance relative to competitors. Combining increasing service share with strong customer loyalty, we expect a higher service mix by 2029, which in turn improve the EBIT margin to 13%.
Now let's see how technical edge unlocks higher revenues and margins. Burkhardt maintains competitive edge by focusing exclusively on reciprocating compressor, investing 2 to 3% of its revenue into R&D, outpacing competitors whose budget covers broader compressor categories. R&D fuels innovation areas such as advanced seal technology, digital monitoring solution, which attract new customers by improving performance and ESG compliance. Building on this commitment to innovation, Burkhardt value engineering projects are delivering significant cost savings. We conservatively estimated the savings to reduce the system division COGS by 4.5%. These three key drivers form a comprehensive strategy that drives sales growth, control COGS, and improve EBIT margin over the long term. That's why Burkhardt deserves your attention.
For ESG, Burkhardt has different initiatives in place that are already delivering measurable impact. Superior technology supports the energy transition and lower the environmental impact, while Burkhardt ranks among the top Swiss employers and leads with the highest share of executive compensation tied to ESG performance. These initiatives reduce the environmental risk, improve brand reputation, and align with investor perceptions. Based on our ESG analysis, we found that the 10 basis points reduction in the WACC is justified because our assessment results in a solid B rating, which is higher than Refinitive's current rating due to the recent ESG improvements that rating agencies often overlook.
Now let's speak about Burkhardt's financial position. Burkhardt revenue growth are driven by strong market expansion in the system division. So as the installed base grow, the high margin service division will capture a larger portion of the product mix, ensuring sustained revenue growth across both divisions. EBIT margin are set to expand by 90 basis points and to reach 13.3% by 2029. This improvement is led by cost reduction initiative in the system division and the growing share of the services, offsetting minor cost pressure, including short-term volatility from recent tariffs. Burkhardt outperformed peers with 2 times higher 5-year average return on invested capital and 1.9 times higher return on equity, reflecting superior efficiency and profitability. By 2029, earnings per share are set to reach 41 Swiss francs, while dividend rise to 24 francs, ensuring steady earning growth and value creation for shareholders.
In our valuation, we first used the discounted cash flow model where we calculated a cost of capital of 8% after adjusting for ESG performance. By applying a terminal growth rate of 2.5%, we determined a target price of 622 Swiss francs and an upside of 22%. But what's really driving this valuation is the free cash flow that is set to improve thanks to the company's operational efficiency improvements, margin expansion, and steady revenue growth. To further validate our DCF model, we also conducted a scenario analysis by impacting our key assumptions. In the bull case, we assume faster expansion into low-pressure boil-off gas and no long-term impact due to the recent tariffs on Burkhardt's operations. This leads us to a target price of 757 Swiss francs and a significant upside of 48%. In the bear case, however, we factor in increased competition and prolonged tariff pressures to drive the share price down to 405 Swiss francs, a negative 21% downside. Overall, the scenario analysis showcases an attractive risk-to-reward profile for the company despite tariff uncertainties. Our relative valuation using the EV to EBIT multiple further confirms our recommendation. The company's substantial service division warrants a higher target multiple similar to its service peers. By using a revenue-weighted approach, we arrive at a target multiple of 19 and a target price of 681 Swiss francs, further reinforcing that this stock is undervalued. We also conducted a Monte Carlo simulation which supports our buy recommendation with a 72% probability. While all our models support our thesis, our final target price of 622 Swiss francs is entirely DCF determined, represents a 22% upside. As for the investment risk, the recent tariffs will primarily impact Burkhardt's service division, while the systems division remains protected due to minimal US exposure. We view tariff risk as temporary, and with Bukat's geographic diversification, it provides a natural insulation from the trade tensions. With a target price of 622 and an upside of 22%, Bukat is a strong contender for any portfolio. With strong fundamentals and momentum, this stock is truly engineered for tomorrow. Thank you for listening. We're open for questions.
Thank you. Judges, you can now turn on your video. The Q&A portion will be a minimum of 10 minutes and a maximum of 15 minutes. If there are no additional questions from the judges after the 10-minute mark, I will end the Q&A. Time will begin once a judge speaks the first word. Feel free to begin.
Hello, thank you for the presentation. What's the reason for the divergence between your ESG assessment outcome and Refinitiv score?
So based on our ESG analysis, we have found that Bukat was doing measurable progress across the ESG, especially in the environmental pillar. We have seen that Bukat was setting clear emission targets and have increased the share of renewable electricity, but they also have launched different initiatives such as BC Activate that reduce the greenhouse gas emissions of the end users. And with a strong board oversight and clear social initiatives, we choose that 10 basis points represent Bukat's ESG progress. And now I get why is it different to Refinitiv is that there's a high lack of methodological differences and a lack of standardization.
Okay, can you please discuss a little bit more the free cash flow generation that you expect in the future? I'm not talking about the absolute numbers, but how will that be allocated to CapEx, acquisitions, if any, or returning money to shareholders, buybacks, dividends, whatever? Oh, sorry, also something on the debt situation, because I have no idea if Burkhardt has a lot of debt, little debt, debt cash, whatever.
I can take this question. So in our CapEx assumptions, firstly, so the company has clearly mentioned that they don't have any plans to expand their facilities in the near term. So our CapEx remains mostly for maintenance purposes. The major assumption that we've taken is regarding the net working capital. Bukat is definitely exposed to cyclical markets, and because of their project cycles, they have periods where net working capital increases dramatically, and it's also decreases dramatically, as you can see historically in 2024, where they had an extraordinary amount of net working capital requirements due to their extraordinary order backlog that they received in the last year. But this is not expected to continue in the future because the company also has stated that they have plans to lease additional facilities in these kinds of circumstances. And regarding your question on their debt, Bukat does issue a bond of 100 million Swiss francs recently, but their overall debt relative to their equity remains low, around 8 to 9% of the overall structure.
How about relative to EBITDA or free cash flows?
So relative to EBITDA or free cash flows, the debt does still remain low. And with regards to even its peers, Bukat's capital structure typically follows the Swiss machinery industry and follows the overall ratio between 80 and 20 ratio.
Okay, thank you.
Hi, this is Asad. Just a question on the same slide which you just opened. If I understand correctly, so the free cash flow was negative in 2024?
Yes. So
okay. Yeah.
The company actually had due to the huge order backlog they had in 2023 and 2024, the company faced extraordinary net working capitals in 2024. And the company also paid out dividends in last year. That was the surprising part. But during our discussions with the management, the company reinforced that they don't expect this to happen again in the future. And they are very dedicated to paying out dividends, even despite negative free cash flows.
But if you look at the trend on the graph you have created, there's an overall downward free cash flow. It started from 150 and then it's continuously going down, maybe slightly adjusted upward in 2023, but then it's again down in 2024. And the upward tick is basically the projections in 2025.
Yeah.
So effectively, we are assuming that whatever the problem they had in prior years will be offset in future years. Correct.
Yeah. So this comes back to the project cycles that this company specifically faces. So they have a project cycle of between 2 to 3 years. So any dip in the increase in net working capital in the previous years is expected to subside because of the completion of the existing projects. So once the newer projects comes and they start delivering with an increased capacity thanks to the leasing of newer facilities, it is set to improve in the near term.
There's a cyclicality element here, or some kind of seasonality, you can say that.
Yes. So the end markets that Burkhardt typically operates in, such as oil and gas markets, they are exposed to a slight amount of cyclicality. But also, this is slightly offset by our projections of the increasing service division, which ensures consistent revenues in the future.
So the projection is based on consistency, although historically there is some kind of cyclicality. Yeah.
Yes.
Okay.
And also our projection of the increase in the service division's overall revenue share.
And WACC is good to see that it's easily adjusted, but you think that WACC is in line with the similar companies, 8%?
Yes, actually, this kind of companies, industrial companies in general, have a WACC of close to have a range between 7.5 to 8.5%, and all the closest peers and competitors we compared all had a similar kind of beta, and our estimate closely follows that.
Okay. And the last question is on the ESG side, that you have taken the impact of ESG on the WACC, but you have not considered the ESG impact on the cash flows. So you think that it's reasonable to adjust the WACC rather than the cash flows?
Yes, we wanted to avoid it because we found it as double counting, since its benefits are already captured to the exposure to the transitional markets. And Burkhardt, also when we think about the investments in hydrogen and solar, they're already incorporated in its environmental contributions. So we find it more reasonable to reflect this impact to the risk parameters than operational cash flows.
Thank you.
Okay, one question about slide 26 and 29. In the bear scenario, you estimated a 21% downfall of the company valuation. Looking at the slide number 29, page 29, you put a 100% probability of the risk of US tariff and the 75% severity of the impact of this kind of occurrence, market occurrence. And finally, at page 38, you also highlighted that there is a very strong competition in the market. I would like you to elaborate a little bit on how did you factor all of this into your model. Thank you, and congratulations for the presentation.
So for the tariff, the immediate impact will be on the service division, as the Burkhardt will bear the tariffs that on the spare parts they import from China and the region to the US market. However, the system division will show no impact, as there's low exposure to the US market and the global diversification. So we included this in our base case. And my colleague will continue with the second part of the question.
So regarding your question about the probability and the severity of the US tariffs, so the US tariffs have already happened and presents a significant risk to all the companies in this industry. So, but we believe in our expectations that the most immediate impact is going to be felt on Burkhardt's service division, and it's going to affect their EBIT margins. Like my colleague mentioned, the export of spare parts that is happening from Switzerland and not China, Switzerland to US. And the systems division, though, will remain protected because of their minimal US exposure and the number of compressors they sell directly to the US. And regarding your question about the severity being at 75%, we believe that it's a valid number because of the uncertainty involved in the whole tariff risk itself. So it's better to take a more cautious approach than be more conservative.
Okay. Thank you very much.
What is the company's unique value proposition compared to global competitors? And are there any strategic partnerships with OEMs, energy companies, or governments?
I would like to take this question. So the company competitive position is that first, Phuket, it has the specialization in fully in reciprocating compressors. Second is that it has superior technical differentiation, especially owning proprietary technologies and intellectual properties that is very difficult for competitor to replicate, and the extensive expertise of 180 years that create a high entry barrier for competitors to enter. As regarding to the partnerships, Phuket have strategic partnership across continents, such as in the US, it has partnership with KB Delta for supporting the spare parts for the local US market, as well as the ownership of intellectual property in Phuket, in Indian market, which allow increasing revenue for the pipeline in the coming years.
And if I may add on to that, so as we said, Burkhardt has superior systems technology. They provide superior compressors that are more efficient and more durable than competitors. It's also being seen with multiple projects around the world. So they have strong presence with hydrogen projects in Europe. The same goes for China, and they are working with different companies as Hanwha Ocean in South Korea, and also they provide compressors for new LNG terminal in Germany. So they have different. So they cooperate with different companies across different continents, and they are present in different various markets.
Sorry, I was off. Sorry. Very quickly, building on a previous question, if you go to slide 28, your football field valuation, it looks like there is more downside risk than upside potential, with the exception of sell-side estimates, which, they are biased. So isn't there a risk that to meet your target price, everything has to go perfectly as expected with improvements and all these things, while there is a risk to downside if not all these things actually happen in the future? So there isn't a very big margin of safety, to be precise.
I can take this question. So, of course, you're right that certain things have to play out for Burkhardt to externally reach their target price and potentially the bull case. But we believe that the company is exceptionally well positioned at this moment with material projects and material investments that could lead them to their target price and potentially to the bull case. And our entire thesis have really highlighted Burkhardt's technical superiority. And we believe that this is going to continue in the future as well because of their extensive R&D investments in comparison to their closest competitors. So the whole idea of them capturing the new market share relies on this, and we believe that the company is well positioned to capture this as well.
Okay. Thank you, University of Neuchatel. At this time, all 5 teams have now presented. The judges will be moved to a separate room to begin deliberations, and please make sure to rejoin the Zoom session in about 30 minutes to hear which teams are advancing.
Thank you, and welcome back, and sincere congratulations. We've heard some remarkable presentations today. The level of thought, attention to detail, insightful analysis, teamwork, presentation skills. I could go on. You have all impressed us more than we can say. Use this experience, put it on your CV and your LinkedIn page, talk about it in interviews, be ready to talk about what you learned, what went well, and the things you would do differently. Thoughtful reflection is the surest way to impress an interviewer. Every team today has already enjoyed significant success in this competition, but only 2 can proceed to the CFA Institute Research Challenge Global Final. So, no more waiting. The judges have scored all the teams and the results are in. The 2 teams that will be representing the Europe, Middle East and Africa region at the Global Final in Chicago on the 5th of May are the University of Neuchatel, representing CFA Society of Switzerland, and Kozminski University, representing CFA Society Poland. Thank you to all the teams and judges for your hard work and dedication. Congratulations again to the 2 teams advancing to the global final. Samantha will be in contact with advancing teams by early next week. Well done, everyone, and good